Alright guys, let's talk about the markets, because this is where the Iran story starts hitting global markets in a real way. Because even after Trump paused attacks on Iranian energy facilities for 10 days, oil prices are still swinging, and that tells you traders do not think the risk is gone. Now Reuters reports Brent was up nearly 3% on Friday at around $111 per barrel, with WTI nearing $97. But at the same time, both benchmarks were still heading for their first weekly decline since the war began. So the market is basically caught between two ideas at once. Maybe there's a short-term pause, but the bigger supply risk is still very much active. And that makes sense because the pause itself doesn't solve the actual problem. The key issue is still the Strait of Hormuz, one of the most important oil choke points in the world. Reuters say the war has already removed around 11 million barrels per day from global supply, and analysts are warning that if the conflict drags on, the market could tighten even further. What's also interesting is that this is now showing up in how the market is structured, not just in the headline price. Reuters reports that Asian refiners are starting to shift from Dubai pricing to Brent for US crude purchases because the Middle East benchmark has become distorted by the conflict. Another Reuters report says Dubai crude premium slumped 65% this week after previously spiking to abnormal levels. In other words, the market isn't just volatile. Traders are actively changing how they price and hedge oil because of what's happening in the Gulf. And the story goes beyond crude itself. Reuters also say the war is choking petrochemical flows through Hormuz, pushing plastic prices higher and creating shortages across global manufacturing chains. So this is no longer just a trader story. If this continues, it can feed into inflation, industrial costs, and potentially consumer prices as well. So right now, the market is reacting to two competing scenarios. Scenario one, the 10-day pause holds, talks improve, and some of this risk premium starts to come out of oil. Scenario two, the pause fails, shipping remains disrupted, and traders start pricing a much more serious supply shock. And that's why the forecast is still so extreme. Bloomberg reports oil could hit around $200 a barrel if the war lasts into June, while Barclays has warned a prolonged Hormuz disruption could knock 13 to 14 million barrels a day out of the market. So the real story here isn't just that oil is swinging, it's that the markets are still trying to figure out whether this pause is the start of a de-escalation or just a short break before the next major move. Anyway, I'll keep you updated and thank you for watching.